Every time you swipe your card, pay a bill, or just check your bank balance, there's a good chance you're interacting with this hidden giant of the financial world. It's the invisible engine that powers something like 10,000 financial institutions, and it touches pretty much every single household in the US. This is the story of Fiserv.
But that brings up a really interesting question, and it's what we're going to dig into today. In a world that is constantly chasing the next big, flashy fintech unicorn, could this 40-year-old company actually be the smarter, more compelling bet? Well, let's break it down.
Okay, so to really get Fiserv, you have to see it as finance's unseen giant. We're not talking about a trendy startup here. This is the bedrock of the entire system, built up over decades of really steady consolidation and growth. I mean, think about it. Through all the economic cycles, market crashes, and huge tech shifts, Fiserv has shown this track record of just incredible resilience. It's the kind of stability that, honestly, you just don't see much anymore in the world of tech and finance.
And this number says it all, 40. That's 40 consecutive years that Fiserv has delivered double-digit adjusted earnings per share growth. That's a key way to measure how profitable a company is. 40 years. That's not a fluke. It's proof of a business model that is just incredibly durable.
So how in the world do they do it? Well, that brings us to maybe its most important feature, this indispensable moat that protects its business from all the competition out there.
Now, if you're new to the term, a competitive moat is pretty simple. It's just a company's built-in advantage. It's what lets them fight off rivals year after year and keep making money. It's really what separates the truly great businesses from the ones that are just, good.
And Fiserv's moat, its fortress, is built on two massive pillars. First, it has enormous scale. And second, it has incredibly high switching costs, meaning it's a huge pain for its customers to leave. Just look at this chart to see how dominant their scale is. Fiserv runs the core banking systems for 42% of all banks in the United States. Add in just two other players, and you're looking at over 70% of the entire market. They are woven into the very fabric of American finance.
This is exactly why people call them the financial plumbing. It's essential, it's complex, and once a bank builds its entire operation on Fiserv systems, trying to replace it is this massive, multi-year, and frankly, super risky project. So guess what? For the most part, they just don't. But Fiserv isn't just some old legacy banking tech company. A huge transformative acquisition back in 2019 turned it into what you could call a two-engine empire, and it's firing on all cylinders.
Now, Fiserv has always been smart about acquisitions, but the absolute game changer was the $22 billion deal for First Data in 2019. This one move created a powerhouse that now dominates not just in banking tech, but in the world of merchant payments too.
And this slide really breaks down those two engines perfectly. On one side, you have the bank tech business. Super stable, long-term contracts with banks, generating predictable, recurring revenue. On the other side, you have this dynamic merchant payments business, which makes money from transaction fees from millions of stores, especially through its fast-growing Clover platform.
And that brings us to Clover. It's the growth engine that has Wall Street both really excited and a little bit concerned. So let's get into the recent debate. Is this growth story for real, or is it just a bunch of hype?
Okay, so this is the number that had Wall Street worried. Not too long ago, the growth in Clover's total payment volume, that's just the total dollar amount of all the transactions it processes, it slowed down to 8%. For what's supposed to be a key growth story, that number looked pretty sluggish, and yeah, the stock took a hit.
But, and this is a big but, this is the story the market seemed to have missed. Look at these two bars side by side. While the payment volume grew at 8%, Clover's revenue from that volume grew an incredible 30%. So what does that tell you? It tells you Fiserv isn't just processing more payments. They're getting much better at selling high-value software and services on top of them. And hey, don't just take my word for it. This is straight from the source. Fiserv's CFO made it crystal clear, saying, "We are focused on getting volume that can add value. We don't need volume for volume's sake." The strategy completely shifted from just chasing every last transaction to getting profitable, sticky customers who buy into their whole ecosystem.
All right, so what does this all mean if you're thinking about this as an investment? Let's get to the bottom line.
Weighing the pros and cons is key here. The bull case is pretty clear. You've got that durable moat, a 40-year track record of growth, and strong cash flow.
The bear case, on the other hand, really centers on that intense competition from other fintechs, market scrutiny, and the kind of risks any big company faces, like data security or leadership changes.
And here's where it gets really interesting for an investor. As of September 2023, the stock was trading around 14 times forward earnings, which is basically a measure of its price compared to its expected future profits. For a company with this kind of market position and consistent growth, that looks pretty darn compelling. In fact, Morningstar saw it as significantly undervalued at the time, which suggests there might be a real opportunity here.
Which brings us right back to our big question. Is Fiserv just a boring old guard company, or when you look at its powerful moat, its two growth engines, and its valuation, is it actually a coiled spring just waiting to surprise the market? Well, that is the billion-dollar question for investors to decide.